All right, we're going to kick things off with Bert Coleman, who's the legal counsel here at Demotech. This webinar is being recorded, and we will issue the webinar to everyone who is registered with copies of the slides when we get there. But right now, let's give it to Bert Coleman, who will read the opening statement.
Thanks, Paul. If you could jump to the next slide. Yeah, before we jump into the webinar, just a couple of matters of housekeeping. First, we have an antitrust statement. Because participants on this webinar are or may be considered competitors in the insurance marketplace, we are providing this antitrust statement. You acknowledge and agree to avoid any conduct that might violate or create the appearance of a violation of any applicable antitrust laws. This webinar must not be used as a means for competing companies to reach any understanding or agreement, whether express or implied, that restricts competition or in any way impairs the ability of companies to exercise independent business judgment regarding matters affecting competition. Participants must not discuss or agree upon any terms of trade or business strategy concerning products they have or may offer in the future. Such terms include, but are not limited to, prices or premiums, business volume, underwriting terms or standards, market share, customers, types of business written or avoided, coverage terms, territories, reserves, incurred but not reported claims, or profitability. It is your responsibility to be aware of antitrust regulations and antitrust compliance policies and to prevent any type of discussion that violates the same. All right, and one additional notice here on the right-hand side. These materials in this webinar are for informational purposes only. So Demotech does not make recommendations to the companies it reviews and rates, and nothing in this presentation should be construed as a recommendation. An additional note, we will be discussing various metrics and trends in the insurance industry, but please note that when Demotech assigns and monitors financial stability ratings, we do look at a number of factors, and a financial stability rating reflects Demotech's opinion of the overall financial stability of an insurer. Okay, with that out of the way, I will provide a brief introduction on our speakers for today. We have Bob Warren, who is our ratings manager, and also Barry Kessler, who is our chief ratings officer. Bob joined Demotech in 2006 after gaining 25 years of experience at various insurance companies, holding positions as chief financial officer and controller. He has experience working with boards of directors, executive committees, rating and regulatory agencies, state examiners, auditors, external consultants, and reinsurers. Bob provides financial and business analysis support in the formation and monitoring of our financial stability ratings, particularly for P&C insurers and most notably for companies with significant coastal exposure. He's a certified public accountant, inactive, CPCU, and holds a bachelor's in accounting from Franklin University. I believe Barry Kessler will also be on the call. And Barry he's our chief ratings officer. Barry directs the team, resources, and overall process of reviewing, rating, and issuing financial stability ratings. He joined Demotech in 1995. He holds the Chartered Financial Analyst designation and is a graduate of The Ohio State University with degrees in business administration and actuarial science. Under his leadership and expertise, his team has refined their financial statement assessment capabilities and processes. And with those introductions, I will turn it over to Bob to jump into the presentation.
Just a second before Bob begins, Barry was able to make the call, but he is traveling. Will not be able to present during the call, but he is available if people ask questions. I'm sure he will get a response to you.
Thank you, gentlemen. You're going to get the full-blown Bob, in other words. Barry's listening, so I'll try to be good. But what you're seeing now is an agenda. I want to welcome you to the first of 3 webinars Demotech is conducting. There'll be one tomorrow, Wednesday, and one Thursday. Now, normally we save the best until last, but I couldn't be available Thursday, so they moved me to Tuesday, which is fine. We'll still get it covered. We've got an agenda to stick to. For those of you who've had the privilege of working with me under previous circumstances, you know I can tend to get off track and move. So we've got some guardrails up here. I'll try to stay on course. We're going to talk about the state of the industry by the numbers and trends over the past 5 years. This is information that's on a statutory basis from NAIC filers only. So you want to keep that in mind as we're looking at some of the state of the art or state of the industry numbers. The key financial metrics, we are going to look at liquidity, leverage, and reserve development. I'll give you a little bit of detail on the computation of those ratios and those metrics. I want to point out that while these appear to be basic financial metrics, they're very useful because they provide consistency to the users of financial statements. They're time tested. These may seem fairly elementary, but the reality is they've been around for a long time, and it's the KISS principle with these things. The more simple you can keep it, the better it's going to be. We'll talk a little bit about emerging topics. What's noteworthy, national considerations, i.e. inflation, topic that's been around for the last couple of years anyway. We'll talk a little bit about demographics related to, cat events and cat activity. That'll give us an opportunity to cover a few points along the way. With that, we'll get started with the state of the industry by the numbers. The first slide we have here, on the left-hand side, you can see this circle represents the Demotech classification system for companies, for P&C companies. And I don't have a definition in front of me for how we slot these carriers into these categories. But if you send me an email, we'll be more than happy to provide that information to you. We like to use this within these classifications and categories, particularly if we're looking at peer group structures and things of that nature. But you can see here on the left, we've got state specialists that eat up about 24% of the group. Strategic subsidiaries represent about 19%. Coverage specialists come in about 15%. So there's kind of the lion's share of the companies within this classification system. Now, I will mention surplus lines, or maybe excess and surplus lines, E&S carriers. That's probably going to expand the next couple of years. At least anecdotally, we've seen more and more carriers move to writing under the E&S moniker. So I wouldn't be surprised to see that jump up a little bit. On the right-hand side, one thing I wanted to post for this discussion today, for this webinar, is sometimes we kind of lose track of the value of the industry per se. But when you look at these numbers, it becomes pretty evident that there's quite an economic footprint created by the P&C industry. There's 1.1 trillion of direct written premium, a billion here, a billion there, and the next thing you know, you're big. There's about 0.9 trillion of assumed premium and about 1 trillion of ceded premium. So you're looking at almost 0.9 trillion of net written premium for the industry alone. No small measure under any standard. The bottom portion of the right just shows you a snapshot of the balance sheet, really, for the P&C industry. The 3 trillion in assets. One thing I wanted to mention about this is these are admitted assets. They come through on a statutory basis. It's conservative accounting, and it's in place because this happens to represent, hey, if you close your doors today and liquidate investments, etc., you've basically got 3 million available to satisfy claims. The 1.9 trillion in liabilities is really the estimate, obviously, of not only current claims but future claims obligations. And so under the historic accounting formula, you've got assets minus liabilities equals surplus. Well, the surplus for this group of P&C companies is 1.1 trillion. Once again, it's a significant number. And if you think about it, in some cases, they look at net worth or surplus as, hey, you met all your obligations. If you closed your door today, looks like you'd have 1.1 trillion left over to give back to policyholders and investors. Well, that would take a couple of years to satisfy, because that surplus is not only the net worth, but it also represents a cushion, if you will, to absorb whatever improper estimates are in reserves. So if they're under reserved, that's going to come out of surplus. If it's over reserved, it'll go back in. But the reason I wanted to cover some of this ground on this particular slide is just because sometimes we lose track of just how big this industry is and what we've created. The P&C industry, we're going to take a quick look at premium. There's not a lot of earth-shattering information in this slide. I will point out for 5 years, we've covered some major business groups like commercial, homeowner, other, which includes accident and health, workers' comp, and then obviously personal auto. So you can see on this graph, as I said, nothing unexpected here. This is about what you would think would happen just based on normal rate increases that have been taken over the past several years. If you look on the right-hand side to net premium written, you can see that gross has basically gone up 10% over this time frame. And each one of these product categories is fairly consistent. You're not going to see a lot of fluctuation in here. And it's not even necessarily the law of large numbers. It's just the way this business is structured. The net written premium has gone up about 9%. And why hasn't it gone up and more consistent, or at least 10% with the gross? Well, I tend to think that what you're looking at here is several years of elevated reinsurance costs. And within these categories, that would typically hit commercial, homeowner, and personal auto, perhaps more than the other categories. So in looking at this, as I said, there's nothing unusual here. It's significant in terms of the structure of commercial, how much it represents to the total is fairly consistent with what we would expect to see. This next slide, I pulled this out because the previous slide indicated that maybe there's more cost going out in ceded premium that these direct writers are incurring. Ceded premium on the left written is up 10%, which tracks with the gross, so it's fairly consistent with what you would expect to see. On the right-hand side, ceded premium written, excluding nationals, has gone up 11%. We excluded nationals because we're looking at companies that typically aren't heavily reliant on reinsurance, but a significant piece of it for some of the small middle cap companies. So when you exclude those national players, it's gone up 11%. Well, if you compare that to the previous slide, net written only going up 9%, that kind of makes sense. And so what I like to think of is that probably supports, or at least in general terms, supports what I think I see at my desk in most instances. So these middle to small cap companies are paying more for reinsurance than maybe they have in the recent past. One thing I would mention at this point too, with this particular slide, as far as the reinsurance cost is concerned, what I see is compression lower in the tower for these cat reinsurance programs. In other words, from ground zero to maybe layer 1 and 2, the first 2 layers, it's pretty cost prohibitive for some of these smaller entities. The reinsurers don't want to participate down in those layers because of the frequency of the last couple of years through convective storms, those kinds of things. So that's an issue for them. And in some cases, it's not even a cost issue. It's just the capacity is not there. No one's willing to pick it up. So that's something that we've seen recently. And these slides tend to support that. And now we'll switch over to the favorite part of our shop. We all love to talk about losses. Here again, because you're looking at the industry, there's nothing really earth-shattering that pops out on these particular graphs for this slide. If you're looking at the loss ratio on the left-hand side, pretty much what you would expect to see. Now, I will say between personal auto, homeowners, and really the commercial business as well, because of maybe some lingering COVID issues, there's a spike there. You start in 2021, 22, and go into 2023. There was some information in industry articles and things about the private passenger auto market going south again, and maybe the homeowners has always been an issue because of the weather in that time frame. So that industry total arc that you're seeing there is not surprising. Now the good news is, yeah, 2024 probably was relatively quiet compared to 23 and 22. I think everyone has a good feel for what the weather looked like in Texas the prior 3 or 4 years. So while I wouldn't single them out necessarily, but it's a good example of where these losses are coming from. And of course, the workers' comp and other pretty much consistent with what you would expect to see. On the right-hand side, I just wanted to show a little bit of information on loss adjustment expense. And of course, this is the direct defense and cost containment. Now, I'm old enough and been around long enough in the industry that I remember the allocated versus unallocated LAE. I would prefer that. I don't know if that's because I'm over the hill or what the problem is, but for direct defense and cost containment, here again, there's really nothing earth-shattering here. It's pretty much what you would expect to see. Now, the commercial and the workers' comp is going to be higher for obvious reasons, but even the total industry trend is back down now. I would say that maybe over the past couple of years, companies have gotten more efficient, whether it's through technology measures or whatever the case may be. The unfortunate side of that is the plaintiffs' attorneys and the litigators are also utilizing IT or technology to help them sort through this. So the better the industry gets, that doesn't mean or is not necessarily going to result in claims litigation and loss adjustment expense costs either going down or evaporating. It's you've got to move ahead to break even, I think, is what we're seeing here. And whether that's unfortunate or not remains to be seen. But the loss ratios haven't been, other than private passenger auto back those prior 2 years, it's coming back into what's realistic for the companies. And now for the fun stuff, we're going to move into the key financial metrics. And this is liquidity, leverage, loss, and LE reserves to surplus, reserve development. There are a lot more metrics out there if you care to use them or go look. But what I wanted to do today is really go over some of the more fundamental. These are elementary in their nature. Almost anyone can do quick math on these when you're looking at a statutory financial statement, if you know where you're looking. But there's not much of a challenge here for these. Liquidity, as I said, this seems relatively elementary. And if you look at the industry, you're probably not going to see anything too astonishing. It goes back to how insightful this can be. It reminds me of kind of Warren Buffett back in the mid to early 60s. He always said cash was king. And when someone explained to him that in the insurance industry, someone pays you in advance, 12 months in advance premium, and oh, by the way, they may never ask for any of that premium back, or it will be less than the premium they pay. He kind of thought that that was a good situation to take that excess funding and invest it. We had cash flow underwriting for a while, but cash is king. You don't see a lot of debt in the P&C industry because it's not needed, it's not necessary. But when we look at this, it's important, particularly in the mid to small cap companies who are heavily reliant on reinsurance. And there's quite a spend, maybe 30, 40, 50, even 60% of their dollar is attributed to reinsurance costs during that calendar year period. So that liquidity ratio becomes important. It simply takes cash and invested assets to the total liabilities. And this also kind of points out the need for asset managers who are capable of timing those liabilities against those assets, the maturity of those assets. So when you're looking at some of the investment strategies and things in these P&C companies outside the national players, it becomes critical who is actually monitoring and taking care of the investment management for these companies. In our experience, when these companies liquidity ratio, if it dips much below 1 to 1, we're looking for specific reasons that would create that. In other words, if the company has a reinsurance arrangement with maybe a captive, so there's funds held on the balance sheet of both those entities, that may create pressure on there. If it's a growth company and they're experiencing 25, 30, 40+% growth in premium, obviously there's an unearned premium issue sitting out there on the liability side. So that's going to create pressure on that liquidity ratio. But those are all things that you can go in, look at the financial statement, and determine what's creating this, other than the fact that what you're looking for, unfortunately, in some situations is, are they liquidating invested assets to meet claims obligations? If that's the case, you've got a whole different ball game. So while it seems fundamentally elementary, it is a significant measure. Next is leverage. And for us, there's different kinds of leverage. There's balance sheet leverage, there's premium leverage, there's underwriting leverage, there's the leverage your spouse has over you when you forget their birthday. But what we're going to talk about really is balance sheet leverage. So this is simply the total liabilities to surplus. And here again, the industry isn't going to really show you anything dramatic in terms of liability ratios that might be out of whack. And what's the definition of out of whack? Well, it's probably north of 3 to 1. And what you would tend to find when you get higher than 3 to 1, particularly in the middle to small cap companies, there's a struggle there that would revert to liquidity to eventually satisfy those liabilities or those obligations. In some cases, it's not necessarily all unearned premium reserve or all case and IBNR reserves that need to be satisfied. You've got intercompany payable receivables for whatever reason that can tend to be significant. So when you're looking at this, if surplus or if liabilities are 3 times surplus, it probably merits a little bit closer investigation. Now, so far, I've mentioned funds withheld several times, and what we're tending to see on balance sheets for some of these players is there's a great deal more funds withheld balances on the balance sheet for both the primary company and the reinsurer than maybe what we've seen or tended to see the last 4 or 5 years. And this is due to these reinsurers or these captive reinsurers being set up and are they adequately capitalized? They're not trading cash back and forth, but the reality is it's still on the balance sheet, needs to be satisfied. So while we understand the accounting for funds held, uh, it merits a little bit more consideration in our overall process. Next, we're going to take a look at loss and LAE reserves to surplus. This is something that maybe doesn't get a lot of attention, and it's more of an issue for looking at a particular company or a particular individual company and saying, we're looking for consistency here. Other than a new company with obvious growth factors and issues at hand, if it's a legacy financial statement you're looking at, you should be able to see within 3 or 4 points anyway that their case IBNR LAE reserve, their total reserves on page 3 on a net carried basis are fairly consistent. Now that may fluctuate based on reinsurance agreements and changes and things of that nature, but at the end of the day, what we're really looking for here is consistency when we see this. If you look at different companies, the different types of business they may be writing, this is going to look different. Their reserves to surplus. For example, workers' comp only company is going to be significantly different than someone who's writing fire and allied property, and that's it. So, not a tremendous amount of information here. Like I said, it's more of an issue for tracking adequacy of reserves consistent across the company. Reserve development. This is the good, the bad, and the ugly when you start talking about this. One of the issues I've discovered over the years when you're looking at adverse reserve development, management tends to view this reserve development, which is really part 2, Schedule P, part 2 summary, as looking in the rear view mirror. And so the issue is, well, what do I really need to do here if I'm habitually under reserved? I can address that in the future. And if you ask them at that point, they will tell you, they will have no problem telling you that, well, yeah, that's behind us, but we have adequate reserves now. Just look at my actuarial opinion. But then they continue with the trend of adverse reserve development. So we do look at this. You can see that the industry average development plus or minus almost nil. A lot of companies have traditionally posted favorable development. A lot of this has to do with if they're writing in coastal regions, weather-prone states. Some of the things they've experienced in the past have been, well, the development of those weather-related cat events has been somewhat crippling to some of these players because they're getting first notice of loss 36 months after the event. That's significant. There's no management team that's going to cover that. It's just not possible. So consequently, we do look at this. We have conversations with companies regarding this reserve development. You can see the box on the left. It's the percent of companies with adverse development. You may find that a little shocking, but you're talking about all different levels of companies and all different tiers. You can correct chronic adverse reserve development, but it typically takes a little bit of time to do that. It's something that really becomes almost a constant conversation. One thing I will say about this, and this is not just from a rating agency perspective, this is kind of the view. If you're chronically producing adverse loss reserve development of 10% of current year and prior year surplus, what that tells the world is, and it's consistent, what that tells the world is your surplus is overstated by 10%. And so you may get a haircut for that in some instances, but just being aware of it. The other issue you run into is not just the regulators and maybe even the rating agencies looking at this. The Internal Revenue Service is obviously very interested in this because as a taxpayer, understatement, overstatement, this is equivalent to overstating, understating inventory. So yes, there are very, very interested third parties in this. Key metrics, reserve development. I just thought it would be interesting once we saw that 25% of the players are posting adverse reserve development. What accident years is it coming from? And here again, I'm not sure this is much of a surprise as it is just the evidence of, if you're talking about property in general, those short-term claim settlement lines of business, yeah, sure, the more recent accident years are probably going to pop. In this case, for the 1 year and 2 year development, I think it really goes back to a lot of these companies have experienced some significant weather on these property lines, and that's driving some of this. The liability side, the casualty side of the shop, you're going to get more consistency just because of the length of, and the reserve amounts, et cetera, et cetera. But in this case, that reserve development is really coming from maybe 2 or 3 accident years ago. Are they going to be able to clean it up? That would be difficult to do. As I said, some of this is tied to some of these players in the coastal areas getting first notice of loss 36 months after an event. That's tough to manage under any circumstance. The next section, the third item on the agenda, emerging topics, corporate structure, trends, catastrophe activity, exposure creep. This is a little bit better section for me because I can put more of my opinion in here than maybe the prior two, not quite as objective. The corporate structure, we've seen a lot of reciprocal exchanges being created the last couple of years. It's kind of the soup of the day, if you will. Why this structure? A lot of it has to do with clearly the subscriber / membership structure, and then they're charging fees to those people outside the premium, and that goes right into surplus. And it's supposedly that is not subject to claims risk. Well, unfortunately, if you have a reciprocal structure and you consistently have an underwriting loss, eventually you're going to be eating into surplus. And unless it's segregated, which in some cases it is, surplus is surplus. And you need the right to ship to make this work properly. These companies are typically funded with surplus notes through an upstream MGA, some other parent organization, and that's fine. That's how you get it going. We look at all the documentation surrounding these reciprocal exchanges and what the membership structure looks like, the attorney in fact, et cetera, et cetera. The way this is really supposed to work at the end of the day, because we've had conversations with some reciprocal exchanges that maybe aren't performing at the level they should. The way this is supposed to work, you can start it with the surplus notes. The expectation is that the company does well enough to have unassigned surplus available to eventually retire that surplus note. And at that point, the reciprocal exchange is actually owned by the members on a net zero basis. So that's tough to do if the reciprocal exchange habitually reports underwriting losses. So while we see it, we understand it, in some cases we've also seen where it's not functioning properly. And if you're using these membership fees to subsidize the poor underwriting results, that's usually not a good thing. Protected cell captives. Yeah, the key word here is protected. We have a nice little picture of a picket fence at the top of this topic, and that's pretty appropriate because that's essentially what you're doing here. And if it's a close, either a captive or a close closed corporation, you can take those assets, put them in that segregated cell, that protected cell, and it's easier to manage it. Typically, there may be less frictional costs than private reinsurance or whatever else you're trying to accomplish. They may be writing some excess and surplus lines through the protected cell. The regulatory issues, not all states accept these, and so you'll find the popularity of the states that do. There is some caution associated with these, depending on authorized business licenses, the regulatory filings necessary. As far as the rating agencies are concerned, you're looking at a little bit broader review in terms of the rating agencies are going to be looking at supportive documentation to ensure that those assets are isolated for the purpose they're intended, who has access to those assets under what circumstances. So there's a little more paperwork, there's a little more grunt work involved, not only looking at the regulatory, but also the remaining aspects of this thing. Alternative capital resources. I can kind of sum this up quickly on this one. It's out there, it's available. Is it more readily available to some than others? Yes, for obvious reasons. It's just the nature of the beast. It always has been. There's probably a broader range of investors out there willing to participate. We've seen reinsurers more willing to participate. Now, not at 100% equity positions, but participation in setting up newcos, things of that nature. And I just listed reinsurance as an available capital resource for obvious reasons. And then here again, funds withheld, a little bit of between the two entities, the primary carrier and the reinsurer. This is something where what we're seeing, there's certain coverage provided that will be fully funded when the ceded premiums are paid. The cash changes hands if necessary. It's kind of a timing issue, but we do watch the funds withheld a little more closely. Let's see. I love how busy the slide looks. Unfortunately, it's reflective of the cat activity in the country. We tend to look at severity and frequency, and a lot of these issues roll right over into the review of the catastrophe reinsurance programs that are out there. We've seen these programs are sticking strictly to non-named events. Is that bad or good? Well, depends on how you look at it. But if they're non-named events, how are they being covered? Typically under reinsurance agreements with limits on them. Outside the U.S., how do we capture this information and how does it affect the reinsurance market? One thing that's interesting here too, as far as flood and wildfires, etc., the modelers are doing a little bit better job trying to keep pace with this and trying to maintain certification and things of that nature so their models are in sync. This slide I thought was kind of interesting. Now it's showing a 20% year-over-year growth in incurred losses. And what I liked about this initially was there's a lot of states covered in 2021, good number in 2022, 2023 or fewer, and 2024 looks pretty sparse. I think this is probably indicative. One of the issues here, and here again, this is Texas showing up in 2021. They had significant weather events in 22 and 23, but they're not on this because 2021 was so bad. So it's just kind of interesting when you're looking at catastrophe activity, what you're bumping into here. and kind of curious to see what the LA wildfires are going to look like when you start looking at these kinds of issues for cat losses in the future. Exposure creep. I think some of these are pretty obvious, but we'll just touch on them briefly. Structural considerations. I think traveling across this country on a personal basis, there's a lot of construction going on residential property. Most homeowners have inflation guard factors, so it's population growth, it's the value of these personal residences, and oh, by the way, it's higher construction costs due to cat activity and maybe even tariffs, who knows. But the regulatory and legislative uncertainty, that here again, that goes without saying. There's a publication listing judicial hellholes, and maybe that refers to states not favorable to property casualty carriers. Some states move in and off that list depending on who's running the state or who's running the show. One thing I like to look at as far as regulatory and legislative uncertainty is if you're not happy, just wait for another election. If you're happy, just wait for another election. Technology-enabled claims litigation, as I mentioned earlier, is efficient and as practical as P&C companies can be in the use of technology to help them in claim settlement. You can be pretty much assured that the plaintiff's attorneys and the litigators out there are using IT to their advantage as well. So once again, maybe IT in some cases isn't advancing your cause. Maybe it's allowing you to maintain the status quo. With that, I will conclude my comments.
Barry, if you have any comments you would like to add?
No, I just would say that, I'm available, and Bob did a great job of summarizing.
All right. So again, you can address a question offline if you'd like. bwarren@demotech.com or info@demotech.com. It'll find its way to the most appropriate person to answer. All right. At this time, I will conclude the webinar. Thank you all for participating. Bob, thank you for the presentation.